Welcome to vTalkInsight, Market Drivers Daily for March 16th, 2026. A near shutdown of Gulf oil routes, trillion-dollar AI plans, and a jump in event risk are colliding today, and the way markets price that mix of energy shock, tech growth, and volatility will shape cross-asset returns from here. The core macro story remains the Middle East conflict and the near closure of the Strait of Hormuz. But the debate has shifted from how big the initial oil shock is to how long it will last. Brent has surged more than 40% this month and is holding above $100, even as some futures curves still assume a fairly quick normalization. Estimates now put the global oil supply deficit in the 10 to 14 million barrels per day range, as Gulf production cuts and shipping disruptions bite. That supply hole underpins scenarios where prices could push toward $150 within weeks, and in more severe cases, even the $160 to $200 range if the strait stays highly disrupted. The takeaway is that markets are no longer dealing with a transient price spike, but with a genuine flow shock whose duration will heavily influence both inflation and growth paths. On the ground, the disruption is widening beyond the strait itself. Drone strikes on the UAE's Fujairah oil port have halted crude loadings at what had been the main export route outside Hormuz, while attacks around Dubai airport underscore the vulnerability of regional infrastructure. Gulf oil production has been sharply curtailed, with output in the UAE and Kuwait reportedly halved, removing roughly a tenth of global supply in just 2 weeks. At the same time, refinery shutdowns and constrained product flows have driven extreme price spikes, with jet fuel cited near $250 per barrel and Dubai crude above $150, highlighting acute stress in refined products. Because strategic reserves exist primarily for crude rather than petroleum products, this combination of lost production, damaged ports, and product shortages amplifies the risk that supply chain pain persists even after any ceasefire. The shock is also broader than headline crude prices. Disruptions through Hormuz and nearby choke points are affecting liquefied natural gas, fertilizers, aluminum, helium, and key chemicals, all of which matter for agriculture, industrial production, and even semiconductor manufacturing. Shipping traffic through critical Gulf routes has dropped sharply, with many vessels avoiding the area or facing much higher insurance and war risk costs. Some Indian and Chinese tankers are starting to return, but flows are far from normal, and there are limited rerouting options given the geography. For corporates, this is already feeding into higher input and freight costs. And if the disruption extends into the summer, forecasts point to further margin pressure in sectors from European steel to global airlines and packaged food. Central banks now sit squarely in a stagflation dilemma. Oil above $100 is pushing headline inflation higher, and several analyses expect the Federal Reserve to revise up its PCE inflation projections while trimming growth forecasts in response to the Iran-related oil shock. Rate setters in Europe and the UK face an even tougher trade-off, given their heavier energy import dependence and the risk that prolonged prices above $110 could shave meaningful tenths off GDP while adding around a percentage point to inflation. Market pricing for U.S. rate cuts has already been scaled back to roughly 1 cut by year-end, and there is talk of a more hawkish tone if the conflict drags on. Yet many policymakers also stress that this is a supply-driven shock they may try to look through, which makes their communication this week as important for assets as any actual rate move. There are, however, important offsets that could limit the worst-case scenarios. U.S. military strikes have significantly degraded Iran's conventional capabilities, with thousands of targets hit and most ballistic missile and mine-laying capacity reportedly destroyed, reducing the ability to fully close shipping lanes. Strategic and commercial reserves are being deployed, including prior releases of around 400 million barrels in waivers that allowed roughly 130 million barrels of Russian oil already at sea to reach markets. The U.S. is also ramping domestic production and processing Venezuelan barrels after a thaw in relations, and some Gulf infrastructure, such as Iran's main export hub, has been deliberately spared so far. Oil prices have even pulled back from their intramonth peaks despite continued attacks on ports and airports, suggesting that a portion of the market still believes in a gradual normalization path. Asset prices tell a story of tension between genuine shock and residual optimism. Global equities are on track for their weakest month since late 2022, yet futures in the U.S. and Europe are trading higher today, and the S&P 500 sits only a few percent below pre-war levels, even as oil and gasoline remain roughly 40% higher. Energy producers are seeing potential earnings upgrades on the back of sustained prices, while airlines, European steelmakers, and some consumer staples are under pressure as input costs climb and pricing power fades. Safe haven demand supports the U.S. dollar, and gold remains in focus as a long-term portfolio diversifier, even if it has not outperformed every day of this crisis. The next 2 weeks look critical. Progress on reopening Hormuz, clarity on any EU or NATO naval role, and central bank guidance on how much of this is treated as temporary will be key swing factors for risk assets before we turn to the AI narrative. Running alongside the energy shock is a powerful, still intact AI investment story that continues to anchor medium-term growth expectations. Even as higher oil and tighter policy clouds the macro picture, projected AI infrastructure spending of up to $1 trillion and robust chip demand suggest a multi-year capex cycle is underway. For markets, that means large-cap tech and the broader AI ecosystem remains central to equity leadership and earnings resilience, but also a focal point for valuation and funding debates. Nvidia sits at the heart of those debates this week. The company is expected to unveil a new inference chip engineered for higher speed and energy efficiency, directly targeting a crowded field of incumbents and startups vying for AI inference workloads. Options markets, however, are only pricing a roughly 4% move around its GTC event, which implies investors see updates on demand visibility, backlog, and long-term guidance as more consequential than the product announcement itself. Recent easing of U.S. export restrictions on certain AI chips to China could add upside if management signals renewed revenue visibility there, since many current forecasts largely exclude that region. At the same time, Nvidia has already locked in over 60% of available AI chip supply through long-term contracts, with demand reportedly outstripping supply by about 12-1. So near-term growth is constrained more by manufacturing and logistics than by appetite. Importantly, AI demand is broadening well beyond the largest cloud providers. Hundreds of enterprises and startups are now investing in AI deployment, from financial services firms that still see room for alpha generation, to new entrants building sector-specific models and tools. Nvidia's management has floated revenue ambitions of around $1 trillion between 2025 and 2027, with roughly 60% expected from hyperscalers, underscoring how central those clients remain. Yet some analysis suggests these long-term figures are only a modest extension of prior guidance, rather than a dramatic step change, tempering the initial excitement. The takeaway for markets is that while the structural demand story looks strong, incremental surprises may now have to come from mix, software, or ecosystem gains rather than simply higher volume forecasts. Elsewhere in big tech, Meta has become a high-profile example of the trade-off between AI spending and profitability. Reports point to plans to cut roughly 20% of its workforce while committing around $27 billion over 5 years to external cloud infrastructure for AI workloads, moves that have boosted the stock on anticipated cost savings. Yet despite healthy top-line growth in its core apps, Meta's AI initiatives have not yet generated commensurate revenue, and the absence of a large native cloud business, unlike Microsoft or Google, raises questions about how effectively this capex can be monetized. In Asia, Alibaba's decision to consolidate all AI products into a single, profitability-focused unit underlines the same shift from experimentation toward clearer return on investment. These stories highlight that markets are starting to differentiate sharply between AI narratives with visible monetization paths and those that rely mainly on long-dated promises. Financing this AI build-out is getting harder at the margin. Hyperscalers already carry an estimated $700 billion in off-balance sheet operating leases, and rising energy costs and tighter credit conditions add to concerns about how far data center expansion can stretch without pressuring balance sheets. In private credit, valuations for software borrowers exposed to AI disruption are uncertain due to opaque market practices and the early stage of the technology shift, increasing the risk of future write-downs even if systemic contagion is seen as unlikely. Public markets are also adjusting. Some high-profile names, like Adobe, have faced downgrades on leadership and AI competition worries, and recent tech drawdowns suggest investors are demanding more evidence of durable cash flows. Looking ahead, near-term catalysts such as Nvidia's GTC commentary, Micron's results, and further guidance from AI infrastructure providers are likely to drive stock-specific volatility, feeding into the broader swings we are seeing across indices. All of this feeds into a market environment defined by frequent, headline-driven volatility spikes rather than a single clear trend. Over the past week, volatility in oil, rates, and equities has moved higher, while underlying macro data have changed more slowly. Trading conditions in some areas are thin. European equity volumes are running about 40% below recent averages, and price action is often dominated by geopolitical headlines or central bank soundbites rather than fundamentals. That combination of low liquidity and high event risk makes intraday moves more mechanical, as volatility-sensitive strategies are forced to de-risk or re-risk around each shock. Cross-asset signals reinforce that sense of unease. Heightened geopolitical uncertainty is widening credit spreads and lifting the equity risk premium, even as corporate default rates and bank balance sheets do not yet point to a classic credit crunch. Bond yields have been volatile but remain within established ranges, reflecting the market's difficulty in deciding whether current shocks will ultimately be more inflationary or recessionary. Fed funds futures now price only one cut this year, yet some forecasters still expect two, and there is ongoing debate about whether central banks will lean hawkish because of higher headline inflation or dovish in response to weaker growth. Meanwhile, triple witching on Friday, combined with several key central bank meetings and heavy options positioning around large tech names, raises the risk of additional short-term swings. Despite this turbulence, risk appetite has not collapsed. Global equities are experiencing their worst month since late 2022, but indices such as the S&P 500, NASDAQ, and Russell are rebounding today, and strategists generally argue that current conditions do not yet resemble a full-blown recessionary bear market. Institutional investors appear more neutral than outright bearish, holding higher cash balances and tilting toward defensive or familiar names, yet still willing to add selectively when prices adjust. Safe haven flows are evident in a stronger dollar, and gold continues to be viewed as a strategic diversifier, even if near-term performance has lagged some other commodities. The message from positioning is that many portfolios are being managed for elevated volatility and drawdown risk, but without an aggressive flight from risk assets altogether. From here, several watch points will shape the volatility path. On the macro side, central bank meetings and updated forecasts will signal how policymakers balance the trade-off between oil-driven inflation and slowing growth, with any hint of renewed rate hike risk likely to unsettle both bonds and equities. In commodities, the critical issues are whether the Strait of Hormuz sees meaningful reopening in the next 2 weeks, how far refined product prices remain dislocated, and whether strategic reserves can bridge the gap without triggering further demand destruction. For equities, options markets around Nvidia's GTC event, upcoming earnings from AI and energy-intensive sectors, and any widening in credit spreads linked to private credit stress will all be important indicators. In sum, we are in a regime where geopolitics, energy, and AI interact to drive sharp, but potentially short-lived market moves, putting a premium on understanding transmission channels rather than reacting to every headline. To wrap up, the picture today is one of a genuine Middle East energy and supply chain shock that could still escalate if the Strait of Hormuz remains constrained, a powerful but increasingly selective AI investment cycle anchored by Nvidia and big tech, and a volatility backdrop where thin liquidity and dense event calendars amplify every headline. Scenario work around oil paths, central bank reactions, and the durability of AI-driven earnings will likely be more important than any single data point in framing risks across equities, credit, and real assets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.